Ever wonder how the ultra-rich skip out on their taxes while the rest of us lose tens of thousands to Uncle Sam? Like how Michael Bloomberg, making over $2 billion a year, can get away with paying just 4% income taxes against a rate that's supposed to be as high as 37%. Hey Bowtie Nation, Joseph Hogue here, and I'm about to reveal the 5 most used tax tricks billionaires use to avoid capital gains and income taxes, along with how you can use each one. I've got to warn you though, these aren't as easy or as immediate as our previous video on the 7 ways to beat capital gains taxes. Those are the easy strategies. What I'll show you today will take some time to set up, but can lower your tax bill to almost zero. It's how Elon Musk, the world's richest person, gets away with paying an average closer to the lowest rate instead of the highest. For each of these, I'll show you how the tax trick works and how to set it up yourself. Stick around to the end and I'll show you how PayPal founder Peter Thiel created a $5 billion tax-free piggy bank for retirement. This first tax trick is where it starts for a lot of millionaires, avoiding the W-2 and income taxes altogether and getting paid in stock. Despite being the founder and CEO of the world's 5th largest company, Jeff Bezos only draws an $80,000 salary. Instead, he receives billions of dollars in stock awards for his compensation. That's because stock awards aren't taxed as income when they're received, and even when they are, most of the return here is going to be through an increase in value. Since the top tax rate for capital gains is 20%, well below the top income tax rate of 37%, selling shares instead of taking an income can save hundreds of millions of dollars. Now this one is a tougher strategy for those of us regular people out there, but there are ways to take advantage of it. One is just the direct approach, negotiating with your employer to get those stock grants as part of your compensation. The other method is just to start your own company. No matter how small, any company can determine how it pays its employees, and as the CEO, the decision is yours. This next tax trick is just becoming available to more investors and is the #1 way the ultra-rich avoid taxes. The buy, borrow, die strategy. No, this doesn't mean you have to die to take advantage of it. Here, say you've got Richie Rich, making all his money in that stock compensation, but still needs to pay the bills. You can't pay for your yacht on 80 grand a year. So Richie there takes out a loan backed by his stock portfolio. And here, I'm not talking about a margin loan. This is a securities-based loan. Morgan Stanley holds more than 68 billion of these, and Bank of America has loaned out 62 billion. Since the loan-to-value on these is extremely low, like borrowing $100,000 on $1 million portfolio, the interest rates are some of the lowest you'll find. Merrill Lynch offers a rate starting at 3.2% and as low as 0.87% for the ultra-rich. The loans come with flexible payment options, even including no payments at all, just accruing that interest onto the loan amount. If the return on the portfolio is higher than the interest, then that loan-to-value is always going to improve, and you may even be able to use some of that paid interest as a tax deduction. So then each year, old Richie Rich here gets paid in more stock. He takes another loan out against his stock to cover his expenses, but doesn't have any real income, so he never pays income taxes. The loan amount grows, but the portfolio grows faster, so he never has to repay anything. And now here's where that die part comes in. The value of the stock portfolio is marked up to market value when it passes through an estate. And normally, if Richie were to sell his stocks, he would have to pay those taxes on capital gains. But now, if they go to his heirs at market value, no taxes ever owed. They can sell enough to pay off those loans and still pocket billions of dollars. And while most banks require a portfolio of at least $1 million to make a loan, the strategy is open up to regular investors in lots of other ways. Just today, news is out that Amazon employees will be able to use their shares as collateral for a mortgage through Better.com. And I bet it's only a matter of time before more are doing this. Folks, saving on taxes is great, but you still need to pick the right stocks. If you want to see the stocks I'm buying for the next 30 years, my forever stocks, check out the link I'll leave in the description below. It's a free report I put together with the Motley Fool, the 5 stocks I'm buying for 10x growth, my forever stocks. It's totally free. Just click through the link below and sign up for your free report. This next tax trick is the easiest on the list, investing in partnerships like Master Limited Partnerships, or MLPs. Okay, before I get a bunch of comments about how the K-1 tax form is just too complicated and should be avoided, don't knock these until you fully understand the power for saving on taxes. In fact, MLPs like Energy Transfer not only offer market-busting yields as high as 10%, but come with 2 built-in tax breaks that make them better than dividend stocks. So MLPs are a special type of company that distributes its profits each year. For distributing more than 90% of the profits, the company avoids corporate taxes, which makes these great ways to hold assets like pipelines. And most investors don't know just how great a tax break these investments provide. First is the fact that most of your distribution or dividend there is considered a return of capital, upwards of 80%, while only 20% is considered income. In this example, if you buy an MLP for $1,000 and receive a $100 distribution, then that $80 return of capital lowers your cost basis in the investment. Because remember here, with most dividend stocks, you pay taxes on whatever you receive each year. It doesn't matter whether you take that dividend or reinvest it, you lose some of that money to Uncle Sam every single year. But that is not the case with MLPs. Here you're just lowering your cost basis in the shares, but most of that dividend is untaxed until you sell the investment. Now, that would normally mean the more capital gains tax when you do sell the shares, but that's where the second tax trick comes in. If a partnership asset is passed through to an estate, the value gets marked up to market value. In this example, let's say over the years you've collected enough of that return of capital from dividends that your adjusted cost is $535, but the investment is worth $1,250 in the market. Now, if you were to sell, you would pay capital gains on the difference between that $1,250 market value and the $535 cost. But, and this is where it gets great, if this is passed on through to your heirs, their cost basis now becomes that market value, and they owe no taxes if they sell it. That means you've effectively paid no taxes on 80% of the dividends you received the entire time you held the shares. The only downside to these MLPs is that special K-1 tax form you're going to get that shows your distributions, share of the profits, and partnership capital each year. Yes, these can look confusing the first time you get one, but most tax software can easily handle these, and it's the same process every single year. Listen, folks, I've been investing in MLPs for more than a decade, and it is the easiest thing to add these K-1 forms to your taxes. Don't believe all the armchair advisors that rush to the comments saying these are too complicated and should be avoided by regular investors just because they're too lazy to figure it out. 2 more tax secrets left, but all you bowtie citizens know I gotta send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. One of my favorite tax tricks here before revealing Peter Thiel's $5 billion windfall, the power of direct real estate investing. I know buying real estate stocks is way easier, and yes, they should be a part of every investor's portfolio, but don't overlook owning real estate directly. Because of depreciation, real estate shields a lot of income from taxes. Here, imagine you buy a $200,000 rental property. Depreciation means you take that value off of your taxes each year, over 27 years for residential and 39 years for commercial property, and then take that off your income. That is thousands of dollars a year off your income taxes. You also get to take a deduction on any interest paid on the property loan, and better still, with only 25% down on that investment property, you're leveraging your returns higher. That depreciation savings alone can be about 5% return, increasing the total return on real estate to between 10 and 20% a year. Hey, why do you think billionaires like Bill Gates are buying up farmland? Because the average farm of 445 acres is worth $1.7 million and can be rented to just one tenant. You get the same return and tax savings, but it's less management intensive compared to other rental properties. I know it takes time to build up that down payment, but this is definitely one you want to use when your income starts pushing you into those higher tax brackets, and if you're not able to use some of the other tax tricks on this list. And now, how Peter Thiel has made over $5 billion totally tax-free investing in his Roth IRA. Thiel's Roth IRA went from just $2,000 in 1999 to over $5 billion in less than 2 decades, and he will never pay a penny in taxes. As founder and CEO of the company that would become PayPal in 1998, Thiel bought shares in the company with his Roth IRA. Now, since the company was privately held, the share price wasn't determined by the market. He could just make up a price for those founders' shares, which he did at just 0.1% each. He bought 1.7 million shares for the giant sum of $1,700. When eBay bought PayPal in 2002, that investment was worth $28.5 million, and Thiel has since used this strategy on other companies, including Palantir, to grow it to over $5 billion by 2019. Now remember, a Roth IRA is a special retirement account you fund with after-tax money. You don't get that immediate tax deduction like with a traditional IRA, but then you pay no taxes on any money you take out. So Thiel is going to be able to take that money out of his account, billions of dollars in capital gains, without ever paying income taxes or capital gains taxes on it. Of course, we can't all found multiple billion-dollar businesses, but there are other ways to use this strategy. With a self-directed IRA, meaning you can invest in assets beyond just those normal stocks and bonds, You can invest in these private companies through venture capital and angel investing. Get your free report, My Forever Stocks, with the link below, or click on the video to the right for the 7 easiest ways to save on your taxes. 7 capital gains tax savings you can try right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.